Now we've got to react to a video on the housing crash coming. Is it possible the housing market is going to crash another 50% from where we are now? What's happening in the housing market? Well, in this video, we're going to react to Nick from Reventure Consulting, who's got a video, and I'd like to add commentary and insight on specifically some of the arguments that he makes, because I've got some personal insight into exactly these markets, and we'll see. Do I reiterate what Nick has to say, or do I have a different opinion? Let's find out as I hit the play button. Here we go.
Redfin is reporting a massive collapse in investor home buying in America. Specifically, they're reporting that investors are buying roughly half as many homes as they were a year ago. A 46% decline in investor home purchases in the fourth quarter of 2020.
All right, I'm going to pause here quickly. So, Redfin reporting 46% decline in investor home purchases. And Nick goes as far as saying, hey, look, that's actually worse than what we had in 2006, which was a period of having substantially longer periods of fewer investor buys. Now, that's important, because if we go back to 2006, it's important to remember how long it actually took for the housing market slowdown to really begin. The housing market really began slowing down in late 2005. That means you really had your real estate pricing peak potentially as early as late 2005 in some markets. Now, what's crazy about that is we didn't actually think we were in a housing crisis until 2000, probably late 2007, and of course 2008. And then the housing market didn't actually bottom out until about November of 2011. That's about a 6-year period of sliding down in home values. It's pretty remarkable. Now, there are some arguments that because interest rates have skyrocketed from about 2.75% on a 30-year fixed rate mortgage all the way to where we sit now at about 6.75%. That is a 4 percentage point increase in interest rates on the 30-year fix for someone with a 740 credit score, which actually aligns with a 40% decline in purchasing power. It's kind of remarkable to think that that kind of purchasing power decline has happened over the span of just 1 year, when that same kind of decline likely happened over the course of 3 years between 2005 and 2008. And it wasn't until that 3-year decline happened that we actually spawned the foreclosure and short sale crisis, which really started taking hold in 2008, 9, 10, 11, and 12. With 12, we were kind of already coming out, really bottom aligning with about November of 2011. So that's to say that this sort of housing crunch that we're seeing right now, yes, it's more dramatic, but it's also been substantially sped up, in my opinion. Now, there's no guarantee of this, but I believe that because we've sped up the crash so much, and it's led to this decline of not just investor purchasing so much, but also decline in real estate sales volumes so quickly, it's entirely possible that we could actually see the real estate market recover much faster than recovered in the 2005 to 2008 era. So when we're comparing to the last recession, I think it's very important to remember how quickly this housing crash is coming up, and then consider what that could mean going forward. Now, also keep in mind that in this housing crash, we are not facing the type of low quality loan portfolio building that we saw in 2008, where you had dead people get loans, people getting negative 2% interest rate loans, only to see them adjust 6 months later to 7% interest rate loans, and all of a sudden people couldn't afford their homes anymore, and since home values were declining, they couldn't refinance. You're not seeing as much of that right now. People, in fact, you might be seeing a very limited amount of that right now. The average credit score of somebody then was around 670. Today, it's around 770, 100 points higher. You're also required to show you have the ability to repay, and rather than being able to qualify on a negative 2% interest rate, you have to qualify on your highest interest rate that you'll have in the life of your loan. We also have substantially stronger standards for appraisals now than we did in the past. Where in the past you could just call up your buddy to get a property appraised. Now you have a randomly assigned appraiser. And while there are still obviously inefficiencies in any market, things have gotten a lot more difficult, and I would say they're on much stronger foundations today than they were in during the last recession. Now, with that said, what's interesting that I'm noticing is I'm starting to notice a rise in what are called these 3-2-1 loans, where basically sellers are buying down the home buyer's interest rates for the first 1, 2, and then 3 years. So in other words, it's kind of, just going to oversimplify this. Imagine you go in with today interest rates are, let's say, 7%. And a home seller's like, all right, well, I'll buy you down to 5% for the first year, 6% for the second year, and 7% for the third year. And then it makes it feel like the home buyer is actually getting a 5% interest rate. And what's interesting about that is if they are getting a 5% interest rate right now, they might have the expectation that they could just refinance in a year, maybe back to a normal 5% 30-year fixed rate mortgage. That kind of stuff makes me nervous. When people start going into deals suggesting that they're going to be able to refinance in the future, I get very nervous because now you're speculating that you're going to be able to have a payment that you're comfortable with in the future. Now, the good news, and that's something that's different today than in 2008, is that today you actually have to qualify for that 7% rate in 3 years. Whereas back then, you'd only have to qualify for that lower rate, that teaser rate, so to speak. But it's an eerie similarity to 2008 that I don't like seeing or hearing about, mostly because I also feel it's sort of supporting home buyers to say, oh, okay, well, if the seller's going to give me a 5% rate for a year, great, then I'll buy, right? It's supporting this sort of misaligned pricing that we have in real estate because we still deserve a little bit more of a punch in the stomach for home prices to come down. And that process has begun. Now, let's go ahead and continue to see what Nick here says, because so far we're only 15 seconds into his video, and I've already had a lot to say.
22, even bigger than the drops that occurred in 2006 before the last housing crash. And these investors, particularly the big Wall Street investors, are running scared from the US housing market right now, which is of course going to cause home prices to drop by more, because these investors were what was supporting a lot of local housing markets in a metro like Las Vegas. But
okay, let's just pause there. In most areas throughout the United States before the pandemic, investors for residential home purchases represented 15 to 20% of home buyers. Now, in the pandemic, because home prices really started skyrocketing in the probably the first half of 2021 is really when we saw the run. I remember doing weekly market updates on the housing market in April of 2020 and saying, I don't think the market's going to go down. I think it's going to go up. And I put my money where my mouth was. I ended up buying 8 properties in Southern California, each worth over $600,000, 600 to about $1 million. I bought 8 properties in just 2020 because I saw the numbers were bottoming out. I'm like, I gotta buy, which was great because in 2021, everything exploded. I mean, home values went up somewhere around 20, 30% in just a year. It was insane and unsustainable. Part of that reason was you had investors making up, instead of 15 to 20% of home buyers, you actually had investors ending up making up as much as 25% of the market. So yeah, on one hand, it is true. Investors absolutely helped prop up the market. Now, are they the sole reason the market is propped up? Of course not. Most properties still sell to home buyers in single family. And that ratio is now actually turning back to home buyers, where now you're getting back to only maybe about 15 to 20% home buyers as or being investors. And that's pretty typical in sort of this sort of in state of the economic cycle. All right, let's keep listening.
According to Redfin, there was a 67% decline in investor purchases in Vegas, a 67% decline in Phoenix, 63% in Atlanta, 62% in Charlotte. And an interesting
What's really incredible is Vegas and Phoenix were also the bubbly markets, the most bubbly markets of 2008. They got hit the hardest. Florida also was considered one of the bubbly 2008 markets. But interestingly, Florida today actually seems to be much more resilient than the Phoenix or Vegas. If you look at home prices in Florida, you're actually starting to see some areas like West Palm Beach and Tampa start trying to rival prices where they were last year, and potentially they might be able to avoid declines. That's not what you're seeing in Phoenix or Nevada. I'll talk more about them shortly.
Interesting question is, why are these investors bailing on the housing market? And it's simple, folks. They're running out of money. Data from Finsight shows that from the third quarter of 2020 to the second quarter of 2022, these Wall Street investors raised over $32 billion in mortgage-backed securities to go buy homes in the U.S. housing market. But here's the problem now, folks. Over the last 3 quarters, you can see they haven't really been able to raise any money in the mortgage-backed security market,
and this makes sense. There's a massive liquidity crunch happening in markets. We do not have as much money on one hand because the stock market has fallen. The bond market has fallen. People who are diversified, whether they are institutions or retail individuals, have lost money in markets the last year. Unless you were essentially wholly positioned short or cash, your equity in bonds or real estate has gone down, which gives you less money to take and diversify into real estate. This is pretty typical.
That lack of funding is one of the big reasons why these Wall Street investors can't buy as many homes right now, is because the capital is not available to do it. Make no mistake, this is great news for you as a regular home buyer out there. The leverage is now swinging back into your favor in the U.S. housing market and in many cities.
And this is also true. Look, the more prices go down, the more of an opportunity you have to buy lower. Now, I think there's still a lot of patience to be required here, especially because I'm of the belief that the rental market needs to fall first before housing to really hit its bottom. Now, think about that for a moment. I just visited this was actually my second time visiting the Phoenix market, Gilbert, East Mesa market, and I'll be exploring the rest of the market as well here in the near future. But this was my second time visiting the market in just the last about 6 weeks. And what I noticed between my first time visiting Phoenix and my second time visiting the Phoenix area, that East Mesa and Gilbert area, is I noticed a substantial increase in the number of for rent properties and the number of single-family homes with for rent concessions. Concessions like, hey, first month free, which is basically the same thing as reducing your annual rent for a property to get somebody in, to get a property rented. And that is the starting indicator that rents are rolling over. We're certainly not getting the rent growth anymore that we used to get, especially as much more new construction is being built. But on top of that, you also have the expectation that so much additional rental supply is likely to lead to rental price declines. The more you end up having rent price declines, the more uncertainty you create for investors. The more uncertainty you create for investors, the less investors want to buy. And as we saw earlier in the video, when you have fewer investors buying, you have less demand and competition for homes, which could drive home prices down. So it's not just interest rates going up that can actually drive home prices down. It's actually rents declining thanks to an explosion in new construction and the availability of rentals. Whether that's short-term investors like Airbnb investors realizing they can't make their Airbnbs work, so they're renting out properties. It's flippers who realize they can't sell their properties anymore to profit, so they're resorting to renting them out. It's long-term homeowners who do not want to lose their baked-in low interest rate, so they're renting out their properties. Or it's institutions panicking to get properties rented. I actually think the real pain in real estate doesn't actually come until you see rents fall. Now, I think that actually creates a phenomenal opportunity for those who are preparing for that. Obviously, I have a real estate startup called HouseHack, and that's exactly what we're doing. Now, I have more of a bullish mindset on real estate than Nick does, but I think we're still in the early phases of that downtrend, especially since we haven't really seen rents roll over yet, and that is going to change the investing game. We want to see where those rents settle. That way, then, we can compare those rents to prices in markets and see what kind of caps and cash-on-cash returns are we actually looking at when we're investing in real estate. So in other words, more to go. Let's keep listening a little bit.
These home buyers are gaining a much higher share of the home purchases. However, everyone, there's still a big problem in the U.S. housing market that's going to cause prices to go down by more in 2023, and that's the fact that the regular home buyer, you guys out there, you're not really buying many homes either right now. There is a mortgage collapse occurring right now.
Now, I thought this was a great chart that he ends up putting up. It's basically the mortgage application chart. And there's been this fervor, this idea that, hey, you know, people are coming back to renting homes or rather applying for home mortgages in January. And you could see that sort of pop in the data here on the right. But it's still a relatively terrible level. That's compared to 2010 and 11, which is really your bottom of the market over here. And even though you had a pop of applications in 2012 and 13, you still had low applications. Now, low applications does not necessarily mean low prices, because keep in mind that you had over here in 2013 and 14, you actually had very, very large real estate price gains. So this is where I'm going to moderate this and say, hey, just because we have fewer mortgage applications doesn't necessarily mean the housing market is going to fall. But it is interesting to see that inflection point from insanity of everybody wanting to get into real estate after the COVID era. When rates were really cut to zero. But then also you see this January sort of spike in data, which we've seen in so many different data sets, suggesting that, maybe home buyers are returning, right? So it's quite interesting. Someone here asks or says, rents didn't fall yet. Exactly. That's my point. That's like literally the point, is that you're seeing new rents start turning over potentially lower. But broadly in many markets, you're actually not seeing high or lower rental comp like sold properties yet. I'm saying sold in quotes here because really rental property, I consider rented properties rented, right? But closed rental comps. So in many markets, you're not really seeing the declines yet, but you're seeing the backup of inventory, and you're starting to see rental concessions. And rental concessions are always very difficult to use when you're trying to evaluate the real estate market, because think about it this way. If you have properties that are renting for $2,400 a month, but then in the memo it said, by the way, we gave them their first month free, well, that's really like renting the property out for $2,200 a month. But that rent price decline doesn't actually show up in the data yet, which is kind of incredible. Now, I personally think a lot of the data we're looking at is setting up for basically what I thought when I started my housing startup, which was buy time would probably be Q3 to Q4 of 2023. So far, I'm still targeting Q3, Q4 2024. I haven't delayed that, but I'm very cognizant of what's happening. I'm not going to get into Q3, and if there are still red flags that things are still rotating down, I'm obviously not going to pull the trigger and purchase in Q3 if there's still red flags. But so far, I'm still of the belief that by Q3, Q4, we could potentially, as long as inflation indicates that, yeah, we're finally starting to see a turn in inflation, we might then more convincingly see a turn in the housing market where maybe this could be a shorter housing market downturn. But right now, the trends are much worse than they are positive. So in other words, the market that we've been warning about for the last year and a half in the housing market is playing out. We're playing out the pain that you would expect to see in the housing market. Now, we've already seen in many markets home prices down 15, 20%. This is when you look at, for example, Austin, Boise, you're down 20% in some of these markets. If Florida is really one of the few markets that's holding up. Really where you're only looking at maybe 5 to 7% declines, but you're starting to see somewhat of an inflection point up. So you got to pay attention to Florida. Some markets in Florida down 9%, nowhere near the 20% you've seen in other areas, whether that's Phoenix, Arizona, or Boise, or otherwise. Let's take a listen into this portion of Nick's video here, where he essentially charts previous peaks of the housing markets.
Years. These peaks in home prices represent the housing cycle, and we're coming out of a 16-year cycle from 06 to 2022, where we can now see prices have started to go down. And what this graph says is that prices will continue to go down for a long time. Typically,
it's actually not what the graph says. Now, look, out of full respect for Nick, it's clearly an indication of inflection point. And while I agree that the housing market is likely to still go down more before it recovers, it doesn't necessarily tell us how long that housing market has to go down. And as painful as the 2006 peak to crash seems, which implies that we might see a substantial decline, I don't believe that we're in that same environment unless, and this is the one thing that I think could really push us down longer, is if we get institutional liquidations. I think that's really what we're going to have to see, because I think we're much more likely to see a rental collapse than a continuation of a very large housing value collapse. However, that rental collapse could pull down the housing market a little bit more as people demand a higher return on their invested capital. So let me explain that for a moment. As I said earlier in the video, if you have Airbnb landlords who aren't making it anymore in Airbnb turning around and resorting to long-term rentals. You have home owners with locked-in interest rates resorting to long-term rentals. You have maybe iBuyers like the Open Doors or whatever who realize, or the flippers who realize they were idiots for buying at the values they did, and now they have to rent out their properties. In my opinion, you're much more likely to see a substantial real estate rental collapse as the next phase of this housing market turn. Now again, don't get me wrong, housing values have already in some markets fallen 20%. Now I think to get to that next leg lower, we need to go through that rental collapse. Everything, however, is going to be really dependent on the Federal Reserve. If the Federal Reserve is able to convincingly say that they've conquered inflation by, let's say, May, June, July, August, and bond yields start falling on the 10-year Treasury yield from about where we sit now, 3.8 to 3.9%, down to under 2.75%, what you're going to do is very quickly put a floor under the housing market. And that chart does not actually necessarily have to go down for very long, because you could end up seeing home buyers back to interest rates in that 4 to 5% rate. And now you have home buyers who have substantially more cash than they've previously had. Remember, someone who previously had $2,500 to $5,000 in their bank account now sits with somewhere around $12.8 thousand in their bank account. People have substantially more excess savings than they've previously did. And even though the savings rate is lower today, the savings rate is lower because people have more. And because people have more, once we get that strong inflection point to the downside in rates, I wouldn't be surprised to see a floor set under the housing market. That's very, very different from 2006. Now, remember, the most dangerous words in investing are "this time is different." And it's entirely possible that maybe you have sort of this shorter double cycle, right? Where the housing market moves down, then inflation comes down, then the Fed cuts rates or stabilizes rates, and bond market yields fall to where all of a sudden mortgage rates fall and people come back into the housing market. But then all of a sudden inflation comes back and you sort of get a double dip. That's entirely possible as well. Certainly not my base case. But I do believe that we're not looking at the kind of correction that we saw in 2006, which is really where you saw home values fall anywhere between 40 to 50%. Some condo markets were down as much as 55% in housing. And so, consistent with what I've been saying for about the last year, I think most markets are going to experience a 15 to 25% decline in pricing. Some markets might end up having another squeeze in there where you go up to about 30%, and of course some markets will end up being lower, maybe closer to 12%, but on average probably between 15 to 25 is consistent with what we're seeing in the data. But again, that rental crush is something we really want to pay attention to. And we're not quite sure yet how those new home starts are really going to affect the housing market going forward. That's probably one of the big things that I'm paying attention to as well, is the fact that you have many more year-over-year multifamily housing starts right now as you do single-family housing starts. Single-family housing starts year-over-year are down 20%, whereas multifamily housing starts are actually up 9%. And that is another factor that could really weigh on the rental collapse for home values. Now, Nick goes on and shows the affordability of various different areas within markets, and he suggests that the first to crash markets are those with lower affordability. And so far, this is correct, with really the exception of Florida. Take a look at Florida on the right. Florida also showing a very high level of home unaffordability, the more red areas here. However, Florida is really a market that so far is still seeing substantially less building and substantially more buying than the other areas on the West Coast. West Coast, without a doubt, is getting hit harder. Now, Nick ends his video by talking about rental vacancy rates. And the two areas that he's seeing rental vacancy rates skyrocket are Las Vegas, Nevada, followed by Phoenix. And I have to say, both of those are markets that I've actually visited in person within the last week to look at real estate in, as we're educating ourselves for a real estate housing startup. And that's redundant, real estate housing startup. For our housing startup, househack.com. Anyway, what we're seeing is exactly that buildup of rental inventory. And so my biggest concern for the housing market going forward isn't rates going up more. It's actually really rates stabilizing, which is all the pain you really need. And then we're going to get year-over-year comparisons that start showing in the next few months, home prices are falling or have fallen 20%, and what kind of fear that potentially creates in the housing market, right? When all of a sudden people realize that year over year, housing prices aren't actually rising anymore, that could create fear. Here's your year over year Redfin housing data. And look, if we just stabilize at 347 for the national housing data, we stabilize at 347. Well, when we get out here to March and April, when we get out to this area over here being, what is this? This is April right here. Here's March. You get into April. Well, April, you're going to be comparing to 383 comps from a year ago. Well, 347 divided by 383 is a decline of 9.5%. What's that going to do to people's psychology in buying? And at the peak, we'll be comparing 347, assuming no further declines, to 389, which would represent about an 11% decline. And that's on a national basis, right? Now, if this rotates up and we actually catch up, yeah, maybe you have a flat housing market, but it would really require home prices to start rising again. And I don't believe that is likely if rates stay stable where they are. So rates staying stable where they are, home prices are potentially likely to stay stable where they are. Once we get year-over-year fear that sets in, along with the rental value crush in the second half of the year, you could potentially see real estate values leg lower another 5 to 10% for a total of potentially a nationwide 15 to 25% correction. That, in my opinion, then gets a floor set under it once 10-year Treasury yields fall under 3%. Now, we're not sure when that's going to happen. So that is going to be predicated on the market, but it's one of the large signals that I'm looking for. So this summer, I think will be demarcated by potentially the largest amount of fear for home buyers, but also the least amount of competition from investors as rental values fall. Now, the risky part about that as an investor is you don't want to get into buying properties if you're not confident where those rental values are going to go. So that's something that I'm definitely paying attention to as a real estate investor myself. And I'm very anxious to see what happens, although I am patient. And I think this market is really demarcated by a need for patience. If I was a home buyer right now or an investor, as sort of just broad advice as a real estate broker, I'm also a financial advisor, but this isn't personalized financial advice for you because I don't know who you are. But as sort of broad advice, I would be pausing right now. I wouldn't necessarily be super anxious about buying right now, even if I saw something that I thought was a good deal based on recent comps or based on, I could rent it out for X. I would be pausing because I still think some of that pain in rental comps coming down is ahead of us. And then that fear for home valuations is ahead of us. So yeah, in some markets, was there a January boost in enthusiasm? Of course, but that's also very typical because there's usually the lowest supply of homes available in January, and that supply of homes really starts rising throughout the year. And the same is true for buyers. Most buyers aren't actively looking during the holiday season, so I wouldn't be surprised to see an increase over time over the next few months in active listings. Usually you get your peak somewhere between March and May. Now, combine those three factors. Number one, peak availability in May, peak fear from year-over-year comps in May, and potentially still high rates, combined with rental comps falling. May is the end of Q2, right there with June. May, June's going to be an interesting time for the real estate market. So I'd be marking my calendar for May, June. And it's not clear if May, June is going to be the perfect time to buy or December will be the perfect time to buy. But I think May, June is going to be when you hit peak fear. And what that does to prices and your ability to negotiate could be juicy enough to actually start diving in. And that's what we're looking at with my startup. You can learn more about the startup at househack.com. We're raising from accredited investors now. We've got a non-accredited round that probably is going to launch in April, which happens to be perfectly right before May. We'll probably close our funding round before we buy. Probably by May, the end of May, we'll close out, and then we'll be in buying mode. So we're really, really excited. We've got some phenomenal plans for the housing startup. Anyway, again, go to househack.com to learn more. This video isn't a solicitation. But yeah, wow, there's a lot going on in housing. And I think it creates fun opportunities for everyone. And ultimately, everybody should be exploring getting into real estate investing. There's a reason I have a course linked down below called the Zero to Millionaire Real Estate Investing course. That's because I think the easiest way for people to become a millionaire is through real estate. And the opportunities now are starting to look pretty juicy.